Good day, FAC 2601 students, and you have arrived at the Lessons Tool 3 IAS 1 video presentation for financial accounting for companies. Now, the International Accounting Standards prescribes a format disclosure requirement for the presentation of your annual financial statements. When you have arrived at this Lesson Tool 3, please go back and revise the videos on Lessons Tool 1 and 2 that provides you an overview of the introduction to financial accounting for companies. Just again, this is our contact details for immediate correspondence with fac2601@unisa.ac.za, where you can get immediate response on any lesson tool from one of our lecturers. Now, having said that, just to give you an overview and an introduction to the very first items of our agenda today is we quickly browse or give you an overview of the two lessons tools you've already have under your belt. The Introduction to Company Annual Financial Statements and the Companies Act and the Conceptual Framework. We will be dealing with the Annual Financial Statements IAS 1, International Accounting Standards 1, and the example Rainbow Limited, which is in your study material under your lessons tool. Now, having said that, let's look at the introduction to the company annual financial statements, just to give you again a browse overview or a limited overview of what you have already or what you already know with regards to the statement. All right, guys, you must know the introduction to the company financial statements. You have seen that you will be dealing with shares, rights issues, the underwriting of shares, and you will be assessed on the theoretical type discussion questions concerning the lessons tools 1 to 4 for your very first assessment. Now, please go back to the video presentation that have already been done on lessons tools or learning units 1 and learning units 2. You must remember that all the study material is embedded on the site. Please, colleagues, you must be able to interpret the theory and apply it on given questions. I will quickly just highlight some areas that you can see how these questions will be asked in your assessment. Okay, for example, question 1. Capital contributed by the shareholders of a company is known as share capital. When companies require additional funds from the public, the company would normally use the services of a financial institution to handle these additional share issue on their behalf. Kraft Limited underwrites an issue. As you can clearly see from this question, it deals with the underwriting of shares. Now, this is typically what you can expect from assessment 1, where we will give you a theory. You will need to apply it and provide us some calculations. All right, so what does the question states here? Kraft Limited underwrites an issue of 250,000 ordinary shares at R3 each in Sontec Limited. Kraft Limited charges commission of 8% for their services. So Kraft is a client that prescribes to the fact that they will underwrite the full issue of 250,000 shares to be prescribed in Sontec at R3 each. The public took up 235,000 of the shares that were on offer. All right, so what is the required? Please explain and discuss whether Kraft Limited has a liability towards Sontec, and if so, what this amount will be. Now, looking at a glance from this question and on first sight, you can realize that you must know your theory before you can able to apply the theory to the question. As well as second question, calculate the commission payable to Kraft. Yet again, you must know your theory. The theory in this instance is that the underwriter prescribes to the full issue. Therefore, whatever the public doesn't subscribe towards to, Kraft Limited has contractual terms to prescribe to the full issue. Now let's go to the solution. So what is the solution? Kraft Limited is a financial institution that undertakes to underwrite the shares. and therefore Kraft is therefore responsible and provide a guarantee to Sontec that if the whole share issue of shares is not taken up by the public, Kraft Limited will itself take up the remainder. So therefore, colleagues, they must take up the remainder. When it's not fully prescribed, Sontec, not Sontec, Kraft will prescribe to that full issue. Yet again, only 235,000 shares were taken up by the public, and Kraft is thus liable to take up the remainder of the shares in Sontec Limited, 15,000 shares. But the commission is always calculated on the full amount of shares that Kraft prescribes to. Therefore, colleagues, Kraft Limited is therefore liable for 15,000 shares of 45,000 each, and the commission payable must be on the full issue that Kraft has prescribed to, and that is 250,000 times 3 times 8% gives you 60,000 Rand. Now, that is one of the questions that you can expect to receive in the assessment 1 or in a multiple questionnaire in assessment 2. Here's another question. Okay, the International Financial Reporting Standards, IFRS, are accounting standards that are issued by the International Accounting Standards Board with the objectives of providing a common accounting language to increase transparency in the preparation of financial information. Entities that are owner managed and has no public accountability may use IFRS for SMEs, small medium-sized entities. That is what SME stands for. Now, please discuss what is meant with the term public accountability. Yet again, colleagues, this is where you must know the theory that is already in your study material, where you will get answers for this term public accountability. And the public accountability is when entities are debt or equity instruments are traded in the public market, or it's in the process of issuing such instruments for trading in a public market. It holds assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. Most banks, credit unions, insurance companies, securities, broker dealers, mutual funds, and investment banks would meet the second criterion. Now, colleagues, that is in a nutshell what you can expect from assessment or lesson tool 1 and lesson tool 2 that is already been discussed with you. Our main aim today is to look at IAS 1, the company financial statements. This is the crux of the module, that you need to be able to prepare statements of financial position, statement of profit, loss, and other comprehensive income, statement of equity statement for our purposes in financial accounting 2601. That is what we are working towards to, and this is what we are after for today. We are addressing the IAS 1 statements, the formats, and the disclosure note requirements. Now, please note, colleagues, that these formats are already given to you in lesson tool 3. Please make sure that you can draft these statements, and luckily in your instance, you've got access to the material when you prepare your statements. So you can prepare the statements and formats in advance in Excel or Word as you would like to write your assessments. Now, you must know for sure that assessment 3, which is the bulk of the assessment, the bulk work will consist of assessment 3. You will definitely get the required to prepare annual financial statements. Then you have to know the formats. You will have to draw up those annual financial statements in accordance with IAS 1, as well as with the note requirements as we do specify. Please note that the statement of profit, loss, and other comprehensive income can be presented in 2 ways, either by classifying the income and expenditure in terms of the function which give rise to them, or by classifying income and expenditure in terms of their nature. Now, this module preference is the classification of income and expenses according to the function method. Okay, that's on page 30. You must know that format. Okay, we are disclosing financial statements according to the function, and you don't need to know the difference between the two. It will always be as in accordance with the function. Now, colleagues, what are we here today for? We are here to discuss the statement of profit and loss and other comprehensive income, the statement of financial position, the statement of changes in equity, statement of cash flows. That is what we are not dealing with today, because that you will deal with in FAC 2602. And then critically important are also the notes to the financial statements. You have to be able to give us the disclosure note requirements. Okay. So what is the statement of financial position? That shows the financial standing of assets, equity, and liabilities of an entity at a specific date and time. It is as if you take a snapshot, a camera photo shoot of your company's financial standing as of that date. That is critically important as what you stand at the specific date. Now, the statement of profit and loss and other comprehensive income shows the financial result, the difference between income and expenses for a specific financial period, normally a year. So if you were to start off your company today, you will invest in your company, and all the transactions, anything that you sell and you incur expenses, you will record over that period, and the financial result is recorded in your statement of financial position for a specific day. If we were to take the year end of 28th of February 2024, your financial transactions for the year are recorded in your statement of profit or loss, and the result of that, the difference between your income and expenses, are recorded in your statement of financial position as assets, liabilities, and equity, being the profits share for the equity owners. All right, your statement of changes in equity shows how equity changed during a financial period as a result of transactions affecting capital funds. And the statement of cash flow shows how cash was generated and used in operating, investing, and financing activities during the year. Notes to the financial statements, very important, including accounting policy information and additional explanatory information about the risks and uncertainties facing the enterprise. Now, those disclosure note requirements are critically important notes, whereas the users of financial statements base their decisions on. So these notes prescribes what has been recorded in your statements for the period. Okay, so it gives you more detailed explanation of what happened in your statements for the period. All right, the notes to the annual financial statements should present information about the basis of preparation, the specific accounting policies, the disclosed information required not presented elsewhere, and provides additional information not presented elsewhere in the annual financial statements. But that is relevant to an understanding of any item. For example, the contingent liabilities. All right, colleagues, what are we to do here today? It is important to note that whenever you address excuse me, any question of this nature, all right, before you open up the question, all right, don't start from the top of the question. You always go to the required first, because you need to know what is required of you. All right, so if we give you a list of balances when you will prepare the statements, you can go directly to the required, because when you don't look at the required, you don't know whether we will ask the statement of financial position, or the statement of profit or loss, or the statement of equity, or perhaps we only ask of you the notes of the note disclosure in regards to profit before tax, or the PPE note, or the current liabilities note according to leases or whatsoever. All right. So first off, whenever you get a question, you will note the required. The required will state: prepare the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of change in equity, and the relevant notes thereto of Rainbow Limited for the year ended 28th of February 1904, according to the requirements of the International Financial Reporting Standards. Now, that is a big question, and that is exactly what we are after here today, to show you exactly how to deal with questions of this nature. So what can you do then first? Well, colleagues, first off, whenever you get a question like this, having such, maybe it's only the statement of financial position, what can you go and do then? You can go and prepare the statements, which the formats you have in your study material. You must note the name of, on top of the statement, the name of Rainbow Limited, okay, the statement of profit and loss and other comprehensive income for the year ended 19X or whatever. Please note that when you note the question in itself, say it's 40 marks, you can immediately calculate the time that you require for this statement. Okay, normally if it's a 40-mark question, the accounting standard on a second year level, NQF6 level, gives you 1.8 minutes per mark. So if it's a 40-mark question, you know for a fact that it will take you 72 minutes to complete. You cannot go over that, and you must make sure that you address all the notes. So therefore, colleagues, you must come in the habit of knowing that whenever this is a 100-mark question or a 40-mark question or a 60-mark question, you take 60 marks times 1.8, and then you will realize it will take you 108 minutes, okay, to complete. That is the standard that will allow you and take you to the third year level modules. You must become in a habit to only take that amount of time to write your questions and write it out in full. Okay, so then, colleagues, when you have drafted your statements, having it set, having it been the statement of financial position, the statement of profit and loss, excuse me, the statement of changes in equity, then you can go through each and every line item, starting from the question in itself. Check the list of balances. Is the balances given to you at year end? Okay. What is the year end? What are the dates? It's critically important that you look at the year end dates. What balances are you given to? Okay, and then you will go to the additional information to look at what are the which dates are important, what is the depreciation policies, what interest rates are given to you. Before then you can deal with the items systematically per line item affecting certain assets, liabilities, equity, or income and expense items, and then you will address them in that way. Now, colleagues, let me take you through that items. Okay, so if you look at the information, sorry, I just want to get to the question. So if you go through the question in itself, you will notice that this list of balances, for example, 5, which is currently in your study material under your lesson tool 8, lesson tool 3, you will notice on page 36, there's a comprehensive example. Please work through this comprehensive example in your own time, where I can show you what we are dealing with. Like I said, that if you receive a question like this, you can go immediately. You don't even look at this information. You go directly to what is required. Okay. Then, colleagues, once you've read the required, it tells you, prepare the statement of financial position. What can you go and do? You go and prepare the statement, the format. Please note, important, Rainbow Limited, that's the company. You become the company. The statement of financial position as at, that is the date that you take the snapshot of, the date for the statement of financial position. You can go and write the format down, type it down in Excel, have a template for you that you can use. If you don't perhaps have got financial liabilities for this year, or you don't have current tax payable, you can leave it in there and leave it open then. But the format is given to you so that you can use it. Okay. You must note the year-end date, for you are dealing with 28th of February 1904. That is the date that this required section is required of you. It also asks of you statement of profit and loss and other comprehensive income, and statement of change in equity and the relevant notes thereto to Rainbow Limited for the year ended. Okay, colleagues, then, excuse me, you go and prepare the second statement already. You can have it as such, statement of profit and loss. And remember that we said that we will give you the income and expense according to their function. This is the function method. Okay, other income, distribution, cost, administrative expenses. This is the format that is required for you in FAC 2601. You must be able to provide this format, and then you can slot in the given information when we work through systematically through the additional information. Again, the statement of changes in equity, Rainbow Limited. Statement of changes in equity, you must mention the name of the entity, the which statement you are dealing with for the year ended. These are the formats. Property, plant, and note. These are the notes disclosures for the given question. Okay. Investment in subsidiary, financial assets. these are the note disclosures that you must know. I can't go through each and every item here, but these are the notes disclosure formats that you must have for FAC 2601. These are all the notes required for you to note on FAC 2601. Now, colleagues, when we go through the information and you've drafted the statements, okay, then you can move towards the question in itself. You will notice that when are the dates given to you, you can see that the following information was from the books for the year ended 28th of February 19.4. That means that these balances are provided to you as at the year end. Okay, then, so these are all the balances given to you at the year end date. Okay, so let's take a look. Unless they specify otherwise, the dates given to you here, for example, your PPE accumulated depreciation, those are the dates given to you at the end of the financial year. So you can see machinery and equipment at a cost of 800,000 Rand. So that is the initial cost of these machinery and equipment. And this is the accumulative depreciation for machinery and equipment. But we'll come to that we will come to those items. Okay, so please, it's critically important that you note the dates, the year-end dates. Once you've done that, and you've noticed at what date and what balances these information is given to you, you start with the additional information. Okay, then you can use a tick mark to tick off what you've read. Okay, so on 1st of March 19.3, the directors of Lambo decided on the following, which must still be accounted for in the following order. So you must realize that the following additional items have yet to be taken into consideration, and we must account for it. Therefore, colleagues, if you go to the additional information, okay, you can use the balances, okay, and you can go and slot them in according to your financial statements. All right. So the statement of changes in equity, if we go back to your statements, you can see ordinary shares issued at R1 each, 500,000 Rand, 100,000 Rand for 8% preference shares, and then you can go and slot them in. What are the ordinary share capital? 500,000 Rand. Okay. Why do I say 500,000 Rand and 100,000 Rand? Because the additional information state that the following items must still be accounted for. So these balances that we see here is before the items has been recorded. Okay, so the items here are the opening balances and the opening items that we must include in our financial statements. The statement of changes in equity, because the additional information stated that the following items must still be accounted for. Therefore, we will have to go and include them in our statement of changes in equity, statement of financial position, and statement of profit and loss. All right, so you take it systematically, item for item, to go and fill them in. The issue of 80,000 fully paid up ordinary capitalization shares to the amount of 80,000 Rand. Okay, so the issue of capitalization shares, from theory, you will know that those issue of capitalization share coming from your retained earnings of 80,000, and that is an addition to your ordinary share capital. There it is, your balance for share capital is 500,000, as you can see directly from your addition, from your list of balances is 500,000 Rand, and then your preference shares is 100,000 Rand. Proceeds of 50,000 new shares were issued at 65,000 Rand. Okay, so you had, there is 15,000 that you paid for, and the proceeds of 50,000 was 50,000 new shares were issued. So college, you can go and fill it in, which is the proceeds. It's 65,000 for ordinary share capital of 50,000. Okay, and then you take these line items and you complete them line by line item for the additional information. Let's go and look at some PPE items. If you go back to your PPE items, and you will see buildings at cost is 500,000 Rand. Now that buildings at cost okay, is the cost value of the buildings, but we need to go and see what the additional information is, okay, before we can complete this. So let's go to the additional items. To write off all shared expenses, preliminary expenses, and debit issue expenses. That means that you write off these issue expenses under your retained earnings. You tick it off. Okay. The existing land was purchased on 1st of March 19.1 for 50,000. Now look at the dates here. You can see that 1st of March 19.1 for 50,000 and buildings at a cost of 450,000 were completed on 1st of March 19.2. On which date are we dealing with here? We are dealing at the end of 28th of February 19.4. Okay. So here you can see, colleagues, that buildings at a cost of 450,000 were completed on 1st of March. And on 1st of March 19.3, the land was revalued by a sworn appraiser, Mr. White, for 200,000 Rand. Okay, so we've obtained this land of 50,000, okay, at March 19.1. So that is an opening cost, okay, of 450,000, sorry, 50,000 for your land. And we had a cost price of 450,000 for your buildings, which was completed on 1st of March 19.3. So what is your current year? Your current year consists of from 1st of March 19.3 to 28th of February 19.4. That is a full year. So now you can see, colleagues, that you've already included the 50,000 because you've obtained it on 1st of March 19.1. And remember, the land, we don't depreciate land, but we revalue land, whereas buildings can be depreciated over the useful life of the land, which we need to go and look for in the additional information. All right, so the buildings had a cost of 450,000 and were completed on 1st of March 19.2. And on 1st of March 19.3, the land was revalued by a sworn appraiser, Mr. White, for 200,000 on the net replacement basis. No entry to the record revaluation was done. So that means, colleagues, we still need to go and include the revaluation in our financial statements. The directors approved plans to modernize the buildings for 150,000 and work to the amount of 50,000 was complete and paid for on 31st of March 31st of August 19.3, while contracts to the value of 50,000 were already entered into for the following accounting period. So, colleagues, we cannot include the full 150,000 for this year because it was only concluded that additional cost of 50,000 was incurred in the current year. Okay, and therefore that is additions at cost for your buildings of 450,000, and we will come to your accumulated depreciation now, as well as your depreciation for the current year. But your additions is 50,000 and your revaluations on land is 150,000. Now, as you have noted that your cost for your machinery, okay, if we go back to machinery and equipment at cost is 800,000 Rand, and that is your and machinery and equipment had a balance of accumulated depreciation at the year end of 400,000. Okay, at 400,000. That is your accumulated depreciation as at the year end date. And your buildings had accumulated depreciation at 18,500. All right. So to go back to your statements, okay, we know for a fact that your cost at the year-end balance is 800,000. Okay. So that is the cost given to you as at year-end, 19.4. But we don't know at this time what is the depreciation policy for machinery and equipment. We need to go through the additional information to be able to get the opening balances for this interest, for this sake. Okay. So if we go back to the accounting information, the additional information, we noted that we've dealt with the existing land and the buildings, and we note that there were only 50,000 additional costs that was approved in 31st of August 19.3. So the buildings had a cost of 450,000, and there were additional plans to improve these buildings for 50,000. All right, but there were more costs entered into for the following accounting period, but we can't account for it now. Now, remember, when you see buildings and land and machinery and equipment in your additional information, you can write on the side here, you can write depreciation policy. Excuse me. Buildings at cost, depreciation policy. When you look at loans, long-term loan, you can write on the next on the left-hand side here interest rates. Okay, loan to personnel. You can write remuneration of directors note. What are the interest rates? So there are a couple of things that you need to write down before you can continue on completing the financial statements. Now, colleagues, I can't not work through this whole exercise with you line by line item, but I just wanted to address certain things that are important. For example, if you go continue down on your investments at cost, you will notice that Aberdeen Limited, the subsidiary of Rainbow, had 10,000 ordinary shares of 30,000 Rand. And that is the investment in Rainbow. Now, what is a subsidiary of Rainbow? It is when you own the more than majority of shares, or 50%, that will give you a subsidiary of greater than 50% and have majority voting rights. Now, normally in our instances, when if you take the amount of shares and divided it, the amount of shares that you held with your subsidiary and divided by the total amount of shares in issue. And if that consists of more than 50,000, it can be considered as a subsidiary of your entity. Okay, so that is investments in subsidiary of 30,000. Blue Limited listed on the Johannesburg Stock Exchange, okay, 1,000 orange shares. Now, whenever you see that shares are listed on the Johannesburg Stock Exchange, from theory, you must know that these shares are current in nature. That means it's a current financial asset that will be on your current assets section. Because it's speculative in nature and that you can deal with it to earn short-term appreciation. So in a nutshell, the market value of these shares, as you can see also here from board for speculative purposes, it's for 40,000 and you have got 1,000 ordinary shares. Okay, so 50 Rand times 1,000 gives you 50,000 shares, 50,000 Rand. So there's an appreciation of 10,000. Now, if you go back to your statement of financial position, I quickly want to show you your investments in subsidiary, which is the 30,000 there, colleagues, and your financial assets of Cream Limited. And then your current assets are the financial assets that I've just spoken to, and which is your Blue Jeans investment, and that is of speculative in nature. Okay, and that, colleagues, the cream there is shouldn't be cream, but this should be blue. Okay, because this is the security exchange, the current assets held for speculative purposes. And that, colleagues, is your financial assets held for trading. Okay, your other financial assets, excuse me, are not listed for our unlisted entity, and that is Cream. And that is your investment in your entities that are of unlisted that you held for capital appreciation over a longer period of time. Okay. Now, I just want to show you quickly when the current assets, financial asset note disclosure, the note disclosure is the notes to the financial assets, but for financial assets. This is how you can draft and disclose your note disclosure for your financial assets. Now, colleagues, I can't go through each and every item here, but I've given you where this is prescribed in your additional information and what it consists of. Okay, so it will consist of dividends, trade receivables. You will find this in additional information 6.1. You will find this in additional information 6.2, and the 1,000 ordinary shares in Blue Limited in additional information 4.2. What I really want to show you is how we work through consistently through each and every item. Okay. You can also see from these statements where when we dealt with these items consistently through the relevant items, as you have noticed in your financial statements and in the statements, the information provided, that there are certain items that we can see directly from the expenses. Like when we tick them off, ordinary shares, we've put them into your financial statements. The proceeds, the share issue expenses incurred on the above shares, 4,000, 3,000, 2,000, which comes directly from your retained earnings. What is the retained earning balance at 1st of March is 151,900. You will fill it in under your statement of changes in equity, and there it is 151,900. Okay, the income for the year, this is your profit for the year that you complete there, which is 46,132. That's 46,132. The issue of the ordinary shares, we've dealt with the capitalization of shares, is 80,000. Then the written off of the expenses, share issue expense, 4,000, 3,000 for that. The dividends that we need to incorporate from the information when a dividend is declared, but that you can only work through in the additional information when they are talking about it. All right, colleagues. So all I'm saying is that you take line for line item and you deal with those line for line items in accordance with what you've read in the additional information. But before you can do this, for this example, you can work with a suggested solution following my presentation in the PowerPoint, and I've indicated to you which section or additional information is this related to. So if you look at my slides here, and I will show you each and every line item that it is depreciation calculation, because it's critically important that I show you that. But if we come to your filling out of your revenue, your cost of sales, you can see that which items are included in there and where do we get the items from. Okay, especially here in your notes disclosure, I've given you the indication of the name of the entity as well as how and where, what items are it made up of. Okay, so you can work systematically through these items. I will also provide the slides for you in the given scenario in your Moodle platform, and then you can work through it systematically for each and every line item. Okay, colleagues? So it is important that you work with the additional information together with the slides, as well as to see how do we deal with these additional information for the power presentation. Now, colleagues, when you work through the line item and you tick them off that you've dealt with them, okay? For example, the unsecured long-term loan originated on 1st of March 19.3 and is repayable in annual installments of 10,000 on 1st of March every year. Interest for the current year at a current rate of 10% must still be provided for and is payable on 5th of March. Rainbow uses the settlement basis of accounting to account for its financial instruments. So, colleagues, the unsecured long-term loan is repayable in annual installments. So if you go to the additional, if you go to the statements, and this is an effect of the long-term borrowings, which is 40,000, which is the long-term loan. But what is payable of the long-term loan? We've just indicated that 10,000 is payable, and therefore that is under the current liability section, which is 10,000 Rand. So you've got a long-term borrowing of 40,000, and the 10,000 is what is payable in the following 12 months. Therefore, if you go and look under your note disclosure, you will notice that the non-current long-term borrowings, which consist of 50,000, which is the long-term loan, and the current portion of the long-term loan is 10,000, that falls under your current liability section. Therefore, the long-term loan is unsecured and carries interest at 10% per annum and is repayable in annual installments, exactly as what it says to you in your additional information. So, but the note disclosure is critically important to have this note disclosure correct. That is how we present items in this in your statements. Okay. You can go through each and every line item and every note disclosure for these items. The profit before tax note is a very important note disclosure that we always ask. And these are the items that you can see that is normally presented and disclosed for your statements. Okay. Now let's get back to one of the items that I wanted to come back to, and that is your depreciation policy. Like I've told you, that whenever you read information and you note buildings and you note your machinery and equipment, you can write on the side there, depreciation policy. Okay, so we need to go and look for depreciation policies. What is the depreciation policy of this rainbow items? Okay, so it is Rainbow's policy to write off depreciation on machinery and equipment at 20% per annum according to the diminishing balancing method for machinery and equipment. Now, colleagues, whenever we look at depreciation policy, okay, for a reducing balancing method, the reducing balancing method indicates to you that you need to calculate depreciation on the carrying amount. That is cost minus accumulated depreciation, you get the carrying amount, and then you can only charge the 20% or the percentage rate on the balancing method. Now, specifically for machinery and equipment, we noted that the machinery and equipment was given to you, here it is, was given to you at year end at 800,000 Rand. That's the cost, okay? And the accumulated depreciation of machinery and equipment was 400,000, okay? So 800 minus 400,000 gives you 400,000 carrying amount, but when? As at year end, at 28th of February 19.4. But what was the carrying amount at the beginning of the year? Because we don't have the accumulated depreciation at the beginning of the year. Therefore, colleagues, if we go to the slides, you will note that the machinery and equipment is given to you at 800,000 and the accumulated depreciation was given to you at year end. But we need to calculate depreciation according to the diminishing balancing on the carrying amount. So what was the opening carrying amount of machinery and equipment of 500,000? How do we calculate 500,000 Rand? Well, what we need to do is we need to work backwards. Therefore, we know that the depreciation policy, according to the diminishing balancing method, according to your notes, note number 10, it states at 20% per annum. Therefore, if we go back to the slides, what is the calculation? The calculation is 400,000 times 100 divided by 80. Or you can just say 400, which is the carrying amount, working backwards to the opening carrying amount gives you 500,000 Rand. So that, colleagues, give you the opening carrying amount of your machinery and equipment. What is the accumulated depreciation then? Well, 800 minus 500 is then your, because what we know what the cost is 800,000, and 800 minus 500,000 gives you 300,000 Rand accumulated depreciation for machinery and equipment. Okay, but we do not yet know what is the depreciation for the year, but now we can calculate it since we've got the carrying amount at the opening balance. Therefore, 500,000 times 20%, okay, gives you the 100,000 depreciation for machinery and equipment. That is how you deal with this information, calculating depreciation for the year on machinery and equipment that has got a carrying amount depreciation policy, which is 20% on the diminishing balancing method. Now, I've given you also the depreciation. What is the additional information state for buildings? Buildings are depreciated at 2% per annum on the straight line basis. Okay, so what is the straight line basis? That is consistently on the cost. you just calculate the depreciation on the cost at 2% per annum. Okay, so now we can go and calculate 450,000 times 2% equals 9,000, and that is the opening balance. But now, what is the depreciation for the year? Again, is 450,000, and that is 9,500 and 50,000. So why have we got 50,000 there? Because that's the information that was provided to us in the beginning of the year when they told us that 50,000 was approved for the current year. But we had 450,000 of buildings from 1st of March, and then on 31st of August, we must calculate an additional 50,000 of accumulated depreciation for the current year. How do we do that? Okay, so we say that we had 450,000 times 6/12, okay, times 2%. That's 450,000 times 6 divided by 12 times 0.02% gives you 4,500. And then for 500,000, okay, we had the 6/12 times 0.02 is 5,000. That is 4,500 plus 5,000 gives you 9,500 for the additional 50,000 additions that was brought into use and included in the financial statements. Therefore, 9,000 was the opening accumulated depreciation, and therefore 9,500 is the additions depreciation on the additions as well. So you had 450,000 for 6 months of the year, and then you had 500,000 for the additionals of the year. Okay, and land was the revaluation reserve that was revalued, and then you can see, colleagues, in your statement of your financial position and your statement of changes in equity, we record the revaluation of your items. The gain on property revaluation, 200,000 minus 50,000 is 150,000, and that will also fall under your statement of changes in equity, 150,000. There wasn't any opening balance for revaluation, but you must record it in the statement of changes in equity under 140,000. What is the market-to-market reserve? What is the 4,000 Rand? Well, the market-to-market reserve is that gain on the financial assets for items that are not part of your income. It doesn't fall under your other income, but it falls under your other comprehensive income, and that is to do with your cream. Okay, cream is the unlisted company that is held for long-time capital appreciation, and the difference between the value as at year end and the value that you've had at the beginning of the year, you can see that 20,000 minus 16,000 is 4,000. That is your market-to-market reserve. And that is under your statement of changes in equity is 4,000, and that will be your year-end balance of 4,000. And it will. You also need to disclose it as gain on financial asset at fair value through other comprehensive income, which is the difference between 20,000 minus 16,000 and is 40,000. Sorry, 4,000. And the gain on your property revaluation is also other comprehensive income is 150,000. Your opening value of land, and then your revaluation purposes, which is 150,000, which is the difference between 250,000, and that is your other comprehensive income of 154,000. All right, colleagues. Then, if you go back to the additional information, all right, that is where I've indicated to you, you tick off these items line by line item. Okay, as you tick them off and you deal with them, you slot them in to your notes and the statement that it belongs to. Loans to personnel consist of a loan to Mr. Green, the managing director. No repayment was made during the year, and this is remuneration of directors. And 1,500 owing to Mr. Terracotta, the company secretary. The original advance on 1st of June amounted to 3,000. Both these loans are short-term and interest-free. Now, colleagues, you will notice that we've also got a note on remuneration of directors, and the remuneration note of directors at the bottom here, you can go through these items director's fees, salary, other benefits, pension fund, loss of office, and less paid by subsidiaries in total. I unfortunately haven't got the time to work through each and every line item, but the slides does show you where does these items comes from. Okay. So it's critically important that you work together with the line items and you fill these items in where they belong. As I've already explained to you, the gains on financial assets, the gains on property revaluation, and then you can use the asset section, the property, plant, and equipment at carrying value, which is the notes of the statement of financial position. And then you will notice that that amount there will correspond with your statement of financial position as at 108,15500. Now, what is important here to note that these listed items and the profit before tax items is what you get directly from your statement of revenue, a statement of profit and loss, and the revenue items which are separately disclosable. Okay, so the profit before tax note uses the information in the statement of profit and loss, and you need to separately disclose them. Therefore, if you go back to your profit before tax note, the income consists of 4,500. Revenue consists of sale of goods. The profit on sale of non-current assets, 750 Rand. You will get that from the additional information. The fair value adjustment, financial assets at fair value through a profit or loss, 10,000. You can see the income from subsidiary is 4,000. The dividend income, which is financial asset at fair value through profit and loss, 900 and 400, which you can get directly from the information that was given to you in the information. Okay, so you can see here dividends receivable, except from subsidiary, 900 and 400. These items are separately disclosable. Okay, colleagues, so this is how you deal with the financial statements. Okay, so all I wanted to say now is the fact that you need to deal with items separately, line by line item, and complete them as you work through these items. One critically important section is your profit before tax and how do we calculate the profit figure for the year. Because as you can see here in your additional information, when we deal with the profit before tax or the income statement, the statement of profit and loss and other comprehensive income, they have not given you administrative expenses. Okay, so they've given you a profit before tax for the year of 54,500. Okay, and then in the information provided, they've given you that profit before tax for the year was determined after taking the following into account, amongst others. Okay, so they have given you a few items surrounding the income and expenses in this nature, but we needed to go and calculate the administrative expenses. So just to get to that calculation quickly, I want to show you that what they have given you. Okay, the gross profit percentage is 40%. That is given to you in the information, and the profit before tax per list of balances as in the information is 54,500. Then you need to take into consideration what has not been taken into consideration and add or subtract that. So the fair value of items adjusted held for trading financial assets at 50,000 times 1,000 minus 40,000 is the investment of Blue Limited, and that is 10,000. You need to add it to your profit before tax figure, and you need to deduct the interest written off, and the write-off expenses of debentures has not yet been written off. Then you get the 57,500. The difference between the gross profit and the figure there is the figure before certain items need to be separately disclosable. Okay, interest paid to be disclosed separately. So you need to deduct it from those items. They cannot be amalgamated or aggregated because these items are separately disclosable. That's why we need to deduct them. Okay, the reason being for separately disclosable, if you look in your statement of financial, the statement of profit and loss, you can see that interest here, other income, the gain on financial assets, finance cost, they are separately disclosable items. That is why we need to deduct them in this calculation, so that they are separately disclosable. The same with other income. We've given you the information where these items are coming from, and then other income. Now, the reason why this calculation is given to you is because we present the statement of profit and loss according to the function method. And that is where you need to disclose finance cost, other income, distribution expenses separately. And then because administrative expenses were not given, this will be the balancing figure. So you've calculated the gross profit, you add or subtract the interest rate for items separately disclosable, as well as the other income, as well as distribution expenses, and then you will get the administrative expenses. Then that figure is included under your statement of profit and loss and other comprehensive income. Now that you've got the other income figures, you can include the administrative expenses of 1.7 and finance cost 19,900, which is given to you in information, and then colleagues, you can calculate the rest of the items. And then your profit for the year of 46,132 is included in your statement of changes in equity for the year ended. Now, colleagues, it's critically important that you know the format, work through the format with the solution, and take the line by line item together with your financial statements as you have drafted them, together with your note disclosures. This is what you are trying to do and achieve in FAC 2601. Colleagues, that is what I wanted to bring across to you. My time is up. I've given you in the information in my slides, of which I will give to you, and I will provide to you in the specific lesson tool 3. You can work through them, and you can make sure that you work consistently with these statements together with the solution to be able to finalize the IAS 1 with the formats. Colleagues, I'm happy to share this video with you and hope this was insightful, and how to deal with the required section when we are drafting international financial statements according to IFRS. I thank you.